Hi, Steve Van Metre here, and welcome to your weekly economic update. We take about 30 minutes every Friday to try to make sense of markets. Maybe make a little bit of sense today, but certainly the payroll numbers didn't. And I'll be the first to say that I was surprised. Of course, I'm not the only one, because the person who had the best estimate wasn't even close. And so you may have heard the news, there was 266,000 jobs created in November, according to the Bureau of Labor Statistics. Now, there was some negatives to this. One is it did count the returning striking GM employees, which I want to say is somewhere in the 50-some thousand range of workers. They were removed previously. I'm not sure I don't recall how long the strike's been going on or when they were removed, but they've been added back. But what troubles me about this report isn't the number. If that's what the BLS wants to report, I'm okay with it. It's that it doesn't match any of the underlying data at all. I mean, we look at this data every week a lot deeper than most people do. There are people out there that go even deeper if you want to spend the money, and this is free, so it works out pretty well. But it doesn't make a lot of sense. And I'm kind of wondering if the BLS was fixing a mistake that they made from last week. Now, I've got the numbers on the screen behind you, and let me just flip over so you can see them. So this is my tracking spreadsheet where I update every month the headline number here. This is the birth-death model, the number of fictitious jobs either minus, removed, or created here as a positive number, and this is the net difference. And the BLS says, well, you can't just add them together. It's not how it works. But the fact is, last month, or not in October, they had to create 274,000 fictitious jobs to get 156,000 plus print on the headline report. So I'm going to add it up because I can't. Nowhere on their website did they say, here's a proper way to adjust for it. They act like you can't do that. I'm sure there's a way. So I'm wondering if this month are they compensating back for that big 274,000 fictitious job number? Because unlike the headline number, which is heavily revised, in fact, former Fed insiders will tell you this is the most lagging data the Fed uses, and it's also heavily revised. But they never, ever, ever revise the birth-death model. Whatever they print, and that's that. So if we look at the last 3 months, so you have on average down here, it says 142,000 when adjusted for the birth-death model. You can take that for what you want, but somehow I'm struggling with this report. The household survey, which is also released at the same time as the Bureau of Labor Statistics releases the non-farm payroll, it came in and said that there was 83,000 jobs created with 1 in 5 full-time. Now, does that make sense? I mean, when you look at the numbers, so many people just look at the numbers and push buy or sell, and computer algorithms do that extremely well. But sometimes you have to ask yourself if it makes sense. Was there anything going on in the last few months that would give employers a reason to hire a massive amount of people, excluding the upcoming holiday season? Not really. There was really nothing in the data. Now, if you factor the holiday season, what do employers hire? Part-time people. So is this a case where the household survey is right and the non-farm survey is wrong? I don't know. But I do know that this payroll report now also included 5 weeks of data. Now, normally they only have 4. So that we have an extra week of employment that's factored in here. That could be an issue. Again, you have the GM employees. So there are some underlying issues. But when I go back, and you do this with me, we look at the data every week. So we look at retail sales from Redbook. Now, this isn't the official government report, but it's same store sales. And it's been decelerating. So the growth rate's been going down. Guess that way. I'm still not good at this. Maybe I should put arrows on my monitor. But anyways, it's been going down. Well, if all these people are finding work, why is that happening? Why are mortgages, mortgage demand not rising? They're just fairly flattish. They're not even at the cycle peak. Why would that be? If all of these people are going to work, And do they not want a bigger home? Do they not want to move out of their apartment? Do they not want to be in a rental? It doesn't make sense. And then I look at the oil data. We have crude oil that's been having more builds than draws on a weekly basis. Well, if there's demand out there from all these people working, that doesn't make sense. The one that really doesn't make sense to me is the gasoline inventory data, because last month the oil companies cut production of gasoline and raise gas prices, so that way when consumers go to the pump and they pay more, and then the news reports later that supplies are dwindling, they match up. But really they actually cut production. We can see that in the data. And we've pretty much saw consistent weekly gas bills. I think we got one or two draws in there, but consistent build after build, and not little ones, not like a couple 100,000 barrels, but millions of barrels. So are these people walking to work? Again, if all these people are out there doing things, you would think this would make, you'd see it somewhere in the data, but it's not showing up. And that, that's kind of troubling to me that it's not there. I don't know why, but something just doesn't feel right to me. So those are some of the issues that I have with that. I think there was one other one, and it escapes me at the moment. But it just comes back to this weekly data of why can't we see them? Why can't we see all these people that apparently now have more jobs over the last 3 months? And I don't know. But as far as the market's responses, of course, stocks are going to go up on a headline, a big payroll report. Now, they don't always do that. The stock market is missing out on some really important things that are coming up next week, and with a big one next Sunday. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation by a social security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. So next week, we've got the Federal Open Market Committee, or Fed, meeting on Tuesday and Wednesday. Anyone hoping for a rate cut, that would be this guy. Not going to happen. I thought by now the data would actually show that we needed one. And aside from the fact that the Fed has run over $300 billion of various direct or short-term asset purchases over the last few months, I think 3 or 4 months, 4 months now, tells you that the ship is leaking water, and they're, like those cartoons trying to plug all the holes. I think they would need to cut rates to help deal with that. How do you cut rates with a big payroll number like this? In fact, what they're going to do is they're going to run victory. You're going to watch. They're going to run victory laps next week. Say, look, we told you it was a mid-cycle correction. We just needed 3 cuts, and boom, the economy is going to go. And they're not going to say that President Trump is going to be happy about it, but we know he's going to be happy about it, but not happy that the Fed isn't at zero. But the Fed's going to take a victory lap. You watch. Now, the other thing the Fed's probably not going to do, but they could do, is start talking about raising rates again, because they're going to say, wow, look at all these payroll numbers. That's obviously going to lead to inflation. So far, it's not. But look for that. I don't expect them to cut their quantitative easing asset. They're not quantitative easing $60 billion a month asset purchase going into next year. I don't think they can do that. I don't think they want to do it. But they might mention something about that. But the biggest thing coming next Sunday night, that this payroll report just flashed a massive green light to, was the last round of tariff increases to China. Now, I say it's the last round because there have been no announcements of anything beyond this. Now, could there be at some point? Sure. But at some point, President Trump he's going to push this ball forward, or he's going to back off. But he's got a strong payroll report behind him now. I think that's going to help him. I think he's got to do it if he's going to fulfill his agenda. And we know for a fact that China has not done anything that he's asked him to do. And he's punted the ball repeatedly, given them opportunities to move it, and they haven't done it. This time, it hits the consumer. These next round of tariffs will hit the consumer. And I don't think they're ready for that. And I don't think the market is ready for that, nor is it priced in for that. So in today's update, and I want to give credit to my friend in Hong Kong who does remain anonymous, and he might be watching this going, what is he talking about? What did I do? Well, he actually made it into my weekly update that you'll read about. because he and I had some wonderful dialogues about economic data and trying to how do you predict trends and whatnot, and what data is better than others. And we were talking about durable goods and new orders, and one of his issues was, but it includes defense and aircraft spending, which are not something most consumers do, right? I mean, we don't go out and order tanks and guns, and nor do we order large aircraft. So it doesn't give us the accurate picture of the American consumer. Now, why would we want to know what the American consumer is up to? Well, simple. They're 70% of the economy. So if you know that new orders for durable goods with a focus on consumers is going down, then guess what that means? The rest of the economy is shrinking. Now, we know the global economy is shrinking because import and export orders across the globe are going down. They're shrinking. But the U.S. economy seems to be, for the moment, an oasis, but it won't last that way. So one night, probably about a week or so ago, he sent me a message and said, hey, I was digging in the Fed database, and I found a way to strip out defense and aircraft spending. Of course, it was due to the time change. It was late at night, and I wanted to go to bed, but you probably guessed I couldn't help myself because I knew I'd be up at 2 or 3 in the morning digging through his numbers because I wouldn't be able to let it slide. And then I went crazy with it. And I have on my background a row of tabs because this is really interesting data. And when you see how well it correlates to the rest of the economy and what's going on, I don't even think he's ready for this. So I hope he goes and reads the report. He did, just in case you're wondering, my friend, you did remain anonymous. No one knows who you are, where you are, or anything about that. You are referred to as my friend in Hong Kong. So I want to show you what we came up with, because I know he's going to like this too. And you're going to see why when we get to the slides on the non-farm payroll report, why this doesn't make any sense. But at some point it will. At some point it will. So let's go and let's get the first couple of things out of the way that we need to. Is the NASDAQ McClellan Summation Index, our liquidity proxy, is hovering, not moving higher, not moving lower, but looking like it's not able to go higher. And if it doesn't go any higher, then eventually liquidity gets pulled out of the market. We want to see a big pullout here that should bring not only stock prices down, but bond prices up into a bull market. And that's what we're really looking for, because we do know the lending data is slowing down. Although real estate remains really strong. I don't know why that is toward the end of November, if it was due to fear of perhaps rising rates. Obviously, I'm not in the mortgage industry. I don't know what people are being told. But for whatever reason, that did look good. But securities and bank credit went up by $5.7 billion. So banks were back buying bonds last week, even though they are trading a lower price this week. They were buying mostly, Treasury and agency securities. I'm sorry, let's go up here to, they sold some mortgage-backed securities, but we're mostly buying Treasury securities. So again, banks are still buyers. Maybe say, oh, that's, $5 to $6 billion is not a lot. It still is a lot. And then they added $1 billion of non-government insured mortgage-backed securities, and we're flat on non-mortgage or non-Treasury security type bonds. But loans and leases moved higher, the total amount, and that was mostly on residential real estate. Big increase there to $19 billion? A lot. That's huge. It's a big move for residential real estate. So was it people buying homes? See, we're not seeing a huge surge in buying. So is it people refining and cashing out? I don't know. But commercial industrial lending, we'll look at the other slides in a second, but you can see it increased by $6 billion, and consumer loans were down. That's a surprise. Credit card, big drop of $4 billion there. That was a surprise too. So let's go and take a look at those charts before I forget about them, and then later I will say, oh yeah, I meant to do that. Money supply. I wanted to show you something with that too. If we have time, I will make a mental note to do that, and then I'll forget. So that means Monday when I remember. The growth rate slid down slightly to 7.59%. 7.59%. This is mostly being driven by money moving into institutional money markets. This is what's going to come out of brokerage accounts, IRAs, things like that. 6-month rate of change flattened out. The 3-month rate of change flattened out. But this is all due to people selling risk assets and going to cash. Looking at the St. Louis adjusted monetary base, as of December 5th, the monetary base increased $18.6 billion, so hence the red line. This is when the Fed started their massive easing program. They have not eased as much as you're seeing right now since quantitative easing 1. So if the Fed's acting like there's nothing going on, the numbers say that there is. But the monetary base says whatever the Fed's trying to dump this money, is not working. The Fed has injected over $300 billion of some form of easing, and the monetary base has only increased by 18.6. So it either tells you the Fed's policies are being ineffective, or maybe it's going outside the U.S. Could be. The Fed does bail out international banks. If you don't believe that, they do. But you can see for $300 billion, the U.S. economy isn't seeing very much of it. Real estate loan growth is up 4.28% from a year ago. The numbers I had last week, apparently I copy and pasted the data wrong. So we'll pretend that last week's, if you don't remember it. But anyway, 6-month rate of change, I think this says it should be rising, not flat, 2.21%. 3-month rate of change is up. But you notice it's not up a lot despite the big drop in interest rates. Normally when you see a big drop of interest rates like this, you want to see a big surge in borrowing. So there's been a little bit of an increase lately. But again, is that due to fears of rising rates, or is it other economic issues? Maybe people are moving up. I don't know. Could it be because we're not seeing it in the sentiment data where there's a huge interest in buying homes? Again, it could be mostly refinances. Commercial industrial loans did tick up slightly, 3.51%. The 6-month rate of change went up slightly to plus 0.27, and the 3-month rate of change went up but stays negative, is at minus 0.43. So again, contracting commercial and industrial lending growth. This is very synonymous with a recession, is negative commercial industrial lending. Also should not match the increase in payrolls too. Normally when when businesses cut their lending, they cut in payrolls too. All loans and leases, so factoring everything, growth rate is up 5.08% from last year, mostly on the back of real estate. 6-month rate of change is running at 2.12. 3-month rate of change is at 1.15, both suggesting that the growth rate should be headed lower. And here's a big drop. The credit card growth rate down to 3.19% from a year ago. So despite some other data that shows consumers are using credit cards more, the short-term data here says, wow, their growth rate on credit is falling. That is not generally good for the economy. We did look at this earlier this week where equities are pricing in a strong rebound in the global factory sector. I'd say good luck with that, especially with the ISM manufacturing report on new orders. So new orders are really critical, and you can see on this slide provided by Bianco Research that new orders are right where they were in June of 2012, and before that, you're looking at 2009, and you can see this 12-month rate of change, negative here, and that is not consistent with a booming economy at all, just not. Okay, so let me go over to here. You should look at me for a second while I clear some stuff out of the way. All right, now on to the durable goods, new orders, less defense, less aircraft spending, gives us a picture of the consumer. Now you'll notice in blue, it's going to be in blue. And see all these tabs up here? We got a lot of tabs to go through. It's in blue, it's contracting. So what this is telling us is consumer spending should be going down. And so if we look at the 1 to 4 week moving average of initial jobless claims, which I inverted, you can see that as new orders go down in blue, except for recently, generally when new orders go down, so do claims for unemployment claims rise. This is shown inverted. So what this tells me from a payroll perspective, from unemployment claims, that this red line should be going down. More people should be losing their jobs based on this. Let's continue forward. Interest rates usually lead. Interest rates tell us a lot. And so many people spend tens of thousands a year on research? And the answer is just stop and take a look at U.S. Treasury yields, because they tell you when they are falling, that means financial conditions are tight. And when they're rising, financial conditions are easing. And here on a year-over-year rate of change, we see 7-year Treasury yields are falling. I only picked 7 because they closely matched this. It wasn't because I had any insight of why that would matter. Maybe because consumers buy things in around 7-year loans, cars to fridges and things like that. Again, when we talk about durable goods, new orders, we're talking about things not like a candy bar that you eat and consume. We're talking about things that last a while, that you get value at over a period of time. So interest rates on a year-over-year rate of change are going down. And when that happens, usually durable goods, new orders go down. So that makes sense that this is contracting, and we should expect further contraction there. How about the cash freight shipment index? This is just they're both negative. And if you're not, think about it, if you're not ordering something, you're not shipping it. So what does this tell us? It tells us that the freight index is indeed correct, saying, hey, there's weakness here in the shipping market, and it's validating because people are validated that people are not ordering as many durable goods, and so it's not flowing through the pipeline of new orders. That makes sense. Let's take a look at commercial industrial lending. Well, when it starts to go down in red, why does it go down? Let's think about that. If a lot of people went out and ordered washers and dryers, right? That order is going to flow through the pipeline to get to the manufacturer. And do you think the manufacturer is just sitting around on, piles of inventory and parts to build stuff? No. Remember, we're in this just-in-time manufacturing. So they're going to go out and say, hey, I need to get a bunch of metal, and I need a bunch of electronic gizmos and motors and whatnot. And they're going to probably finance all of that. So you're going to see financing go down the channel. Then you're going to see the wholesaler. They're going to finance it from the manufacturer, and the retailer is going to finance it from the wholesaler, and then the consumer is going to finance it from all of them. So you expect to see in this chart exactly what we're seeing here is that as commercial and industrial lending falls, so too should durable goods new orders. Now, durable goods tend to lead the change in the year-over-year rate of change of commercial industrial lending, but the 3-month rate of change is right on the mark. That's why we look at that. Total construction spending, I find this interesting. It did perk up on a year-over-year basis, but again, it's telling us the same thing that if you're building a large construction, like say a building or something, or homes, what are you going to need? You're going to need to order durable goods, lighting fixtures and other things like that. Well, boom, you're seeing it go down. Makes sense. Let's keep going. Consumer prices. Well, if people are buying less stuff, prices go down. They don't go up. All right, when's the last time you went to a car dealer and nobody was buying cars and they had a lot of inventory and they were marking their cars up? Nope. You find that one car that's been on the lot for 6 months, the sales manager will probably give you a deal on it because he's losing money on it. So that makes sense. How about crude oil? Aside from this issue here in 2008, which I meant to get an answer to and I forgot to, isn't this interesting that crude oil, and this is not on a year-over-year rate, it's dollars per barrel. Now, does that make sense? I mean, what is the input that goes into a lot of durable goods that we buy? Crude oil. So this makes sense. So everyone that's been, all the speculators and all the investors are like, crude oil is going to go up, up, up. Well, not if new orders keep going down. Pretty cool, right? Tells you the oil is likely to head down. How about the federal funds rate? Isn't this interesting? When the Fed starts to cut, so new orders go down too. Isn't that interesting? And when the Fed eventually gets around to raising rates, new orders go up. That's just really interesting because, again, if you understand interest rates, rising interest rates indicate looser financial conditions, and falling interest rates mean tighter financial conditions. And in tighter financial conditions, people spend less money because they have less money. How about gold? You wouldn't think, well, how does gold relate to this? Well, it actually does, oddly enough. And this is just US dollars per troy ounce. So this is not a year-over-year rate change in gold. But look at that. When new orders go down, gold goes down. When new orders go up, gold goes up. Why is that? Why is that? Think about it. Why would rising new orders lead to higher gold prices? If I'm manufacturing washers and dryers and I own the company, maybe I like gold and I'm making more money, so I go buy some. Maybe my management team likes gold, they go buy some. Maybe my employees are making more money. Get it? They like it too. So what happens is when money is flowing around, people go and spend it. You get that? It's driving prices of oil, it's driving prices of gold. Pretty crazy, right? I mean, who would have thought that when my friend in Hong Kong sent me this, that I was going to go completely crazy with it. But what that tells us is that gold prices should be falling. And it's pretty consistent. Look, you see, here's a point where new orders were going down, gold prices in red were going up, and then all of a sudden, boom, they collapsed. Look at that. I know it doesn't match over in this area here, but it does really well here. Pretty cool, right? Let's go on. How about the money supply? I know you're thinking, there's no way. I got more tabs. How about that? When people are spending money and financing things, it creates money into the economy. And when I take the money supply and I invert it on a year-over-year rate of change, it makes perfect sense. Because why is the money supply rising when new orders are falling? Because people are raising cash. And when new orders are rising, why does the money supply fall? Because they're using the cash. Look how good that is. What did you just learn? The dollar should be rising. Gold should be falling. Oil should stay low. It's pretty crazy stuff. I love it. Institutional money funds. I want to hang on to this slide because there's something I want to do with this. This is the subsect of the money supply that shows money going into money markets. And this is your evidence. Inverted, money flowing into money market funds means there's less money going out into the real economy, being spent, being moved around, or durable goods fall. And look at that. It leads durable goods new orders. It's a leading indicator here by a lot. So as people start raising cash, new orders go down. So cool. How about the monetary base? Well, who would have thought? Perhaps the problem the Fed's having of getting the monetary base to rise, and this is shown on a year-over-year rate of change, is the fact that durable goods new orders are going down and money is not moving around the economy. I hope this is making sense. How about here, total non-farm payrolls? Do you see why I think payroll reports should be headed down? Look right there. Every time durable goods is declining, payroll tends to. Now, is this a boomer effect where we have boomers retiring that's skewing this? Possibly. I don't know, but there you go. How about advanced retail sales? Well, that's a no-brainer. When new orders go down, what is eventually going to lag behind it? Retail sales. How about net percentage of banks tightening? I know you're probably like, there's more? Yes, everything is making sense here, right? Banks are tightening lender standards. Why? Because people are spending less money. The system's creating less money. And this is shown inverted. So what does that tell us? Lending standards should continue to tighten. Interest rates should continue to stay low or go down. How about the trade-weighted dollar? Yep, there's a trade-weighted dollar. It's going down. Oh, the other one was money supply. This is trade-weighted dollar. The dollar follows. I mean, doesn't this make sense? Why would the dollar be more valuable when new orders are going up? Because there's a demand for dollars. And when new orders are going down, there's less demand for dollars. This is shown inverted. So the dollar should be, I'm sorry, I got that backwards. When new orders are falling, the system is creating less dollars. So there's a demand for dollars. Why would there be a demand for dollars in a debt-based economy? Because there's always more debt than there is money to pay it with. So as new orders go down, right, and there's not a lot of borrowing done to create all of these orders and pay for it and finance it and whatnot, which creates money into the economy, the dollar goes up in value. So dollar goes up, money in the money markets goes up, gold goes down, oil goes down, employment goes down, lending standards tighten. This is pretty cool, right? All because of the consumer. How about the unemployment level? This is something we've pretty much looked at. It should be going down. It's not yet. And then last but not least, what about the good old stock market? Well, I don't, for whatever reason, the Fed does not include the S&P 500 historical data. But look at that. When new orders go down, except right now where everyone thinks this is bullish, eventually the stock market figures it out and heads lower. So even new orders tell the stock market where it should be going. Now, oftentimes the stock market in red leads it. But right now, it's lagging it. What did I want to show you with this? Oh, I guess we're not going to look at charts, but that's okay. We'll do that Monday. I want to show you. I hope that was cool. I thought it was really cool. Institutional money funds. Okay, I want that. Yep, just the way it is. Okay, I don't know why my mouse is doing this. When I click left, sometimes it makes it go right. 10-year treasuries yields, add, format, left, move up, oops, left, move up. There we go. We need to go over here. You can see this isn't really super annoying when it does that. Okay, boom. Here's money flowing into institutional money market funds shown inverted. Below in blue in blue is 10-year treasury yield. If I can zoom this in and there it goes. Look at that. Money's flowing into money markets, folks. That's also helping keep interest rates low. You can see this rebound in interest rates at the bottom here. And yet there's just a small tick up in money slowing down into money market funds. This is helping put downward pressure on interest rates. So hope that was really worth your time. We're at the 32-minute mark, so we're going to wrap this up. I appreciate you taking the time to watch. And now we know that durable goods, new orders, excluding defense spending and aircraft spending, tell you virtually where everything in the market will head. Maybe not tomorrow, maybe not next week, but in the months to come, it's a really good indicator. We'll be back Monday with the update and see where the hedge funds are at, and we'll get into some charts then. I'm Steve Van Metre. Hope you have a great weekend. Bye now.